Alright, I'm going to analyze a stock that has gone down a lot in order to figure out why it went down so much and see if I need to panic. So I'm going to pick some stock. I'm going to find, this is a classic case of make up your homework and then do it. So change of close over 20 days is less than -20. So I'm going to go find, surprisingly there's a lot of stocks that match that. Now because I want to find a stock that's actually meaningful, I'm going to add a market cap restriction, because that's the first thing I'm going to do when I analyze this stock. I'm trying to imagine, so the exercise here is imagine you had bought Viacom. You bought Viacom perhaps a month ago, maybe more than a month ago. Maybe you bought it here, or maybe you bought it there. We've all had those days. And between the time you bought it and now, it's down there. It lost half its value. You were utterly hosed. So what we're going to do is an exercise is we're going to try and find a way of describing Viacom and see if you need to react and sell Viacom in this imaginary scenario, or whether you should sit back, relax, and buy more, or do nothing. So the way we're going to do this is we're going to look at Viacom broadly and we're going to try and characterize it, and then we're going to screen for similar stocks that are just like it. And then we're going to try and describe it with using a couple of attributes until we get 10 or 20 stocks that look like Viacom. Maybe they didn't go down 40% in a month. Maybe they did. Actually, it was over a year. Sorry. But we're going to try and buy Viacom. We're going to try and find other clones of Viacom. And then we're going to backtest the result. And if the backtest does well, then you can take heart and say, well, Viacom's just a special snowflake, it will recover. If the backtest underperforms, you have a new thing to watch out for. You can add a red flag to your screeners that tells you when to get out. Some of our red flag screeners, such as lost 4.5% 2 days in a row, were created by exactly this method. I said, I have a stock. It went down 4.5% 2 days in a row. What do I do with it? And the answer is you short it, or at least you don't buy it. Here we have Viacom. It has a Petrosky score of, we're going to look at the score summary to start with, because the first part of this assignment is you study it. Now, its balance sheet score is not great, and its cash flow score is okay, but interestingly, the cash flow score declined, but the scores aren't telling us much of anything. The -2.6 on this Benish is slightly worrisome because -3 or better is good, but it's not terrible. Now, this stock having a score, if you notice all the scores here are between 3 and 7. I'm ignoring the buzz score here. And that tells you that this is a kind of an average middle of the road stock. If it had scores that were 7 or higher, then it would be a special stock. And if it had scores that were 2 or lower, then it would be a stock that was kind of deficient. So the scores aren't telling us anything because this is basically a mediocre stock. So the next thing we do is we look at the EPS history. Let's see what happened there. Let's go ahead and plot the EPS history. Ask for a new tab. Ask and you shall receive. Alright, so the earnings took a swan dive. In particular, it looks like the earnings dropped below our magic line 0. They seem to have recovered recently, but let's see if they've ever dropped below 0 before, or is this the first time they've ever lost money? I'm going to go into the table and I'm going to try and find the other times when the EPS was less than 0. So I'm going to limit my search to EPS, and I'm going to type in minus, and I'm going to scroll around and I'm going to see where all the negative EPSs are. Notice the date column over here is changing. Notice, however, that all these numbers are so far starting with 2015. In fact, by a quick tabular inspection, it has never lost money in the last 10 years. Let's go back 20 years. Go for broke. Oh. That proves to us that we can't do that because Viacom started in existence in 2006. So this is the first time it's lost money. Ever. So, let's go ahead and create a screener. And the way we do this is we create screeners that include Viacom. Now I'm going to get rid of all of this scribble scrabble because we're not looking for performance anymore. I just did that to find the example. Instead, what I'm going to do is I'm going to look for companies that have lost money for the first time ever. I'm going to create another line, and I'm going to say that ever since the earnings per share are less than zero since 1995, and then I'm going to say that this condition, which I've just enumerated must be true now, was not true a year ago. And if I run this, I should get, this will take a while to run. It will go off and it will compute the number, it will compute for all stocks if they've ever lost money. Then it will compute if they've ever lost money a year ago, and we'll be sitting here waiting for 40 seconds. So I'm going to go through this structure again. The ever since allows you to do tests, and if it becomes true, it stays true. This since is a bit weird. What I'm doing is I'm saying that I'm going back to a specific date and time, and I'm calling it true forever. So these are the guys who have ever had to turn in a negative earnings quarter for the first time this last year. So GE apparently has never lost money until sometime this year. Ditto for all these other companies. Now what I'm going to do, we did all that work and it seemed like it was rather a lot of work. Now I'm going to backtest this thing, and I'm going to run it for 10 years, rebalancing quarterly. Now, how did I determine that loss of money was the thing that I was going to key on? Well, it was the first thing I saw. In reality, this might actually make a big difference, or it might not. If it makes a huge difference, then we can stop and think about it. If it doesn't make a huge difference, then we clearly need to go look for some other feature to key on. And we keep doing this to build our intuition. Depending on how thoroughly, if this was some stock you inherited from your great-great-grandmother, you may want to do this for a long time in order to figure out how important this is, because you may want to be very reluctant to sell the stock because you got it for pennies per share. Then again, this is Viacom and it only existed since 2006, so it's probably the case you didn't inherit from your great-great-grandmother. So, here we are, and we can see that recently we've gotten a bit spooked by those things. It underperformed. Now, but if we run off and say, oh, that means we should sell, we've gone too fast. We need to do a little more work to try and, now that we have a hypothesis and it looks like it might kind of sort of be true, we need to try and disprove it. Otherwise we haven't done our full duty and we're going to end up jumping off to the deep end without thinking it through. So the first thing I'm going to do is I'm going to try and nerf some of the conditions and see if that helps or hurts the performance. For example, what if we just take all the companies that have ever lost money without regard to whether it's the first time or not? In theory, if the line gets worse, then that means that all we're keying on is negatives. The line got better. That's actually good for our hypothesis. A company that's always made money and then lost money, that's a bigger deal. If the company loses money half the time, the market doesn't give a rip. It doesn't care. Notice that this population here outperformed. But if I do Command Z to put my ever loss back in and run it, then we're going to get that underperformance again. The second thing I'm going to do is I'm going to nerf it by getting rid of the fact that it ever lost money now. Now I have to be a little bit careful here. If I delete this term, which I'm going to do, I end up deleting the other term as well because I deleted the definition. So I'm going to undo that. That's rather sad for me. Instead, I'm going to settle for redundancy. We're going to say that it's not lost ever, and we're going to say it's not lost ever. And the server will compute the same thing twice, and that's just okay with us. Notice that this line says exactly the same thing as, no it doesn't. This this screen is going to return 0 results because we've just said A and not A. So the way we're going to fix that is I'm just going to delete this term. There. Now there's no ambiguity. These are firms that have never lost money. We're going to backtest this pile of beans, and we're going to see what happens to sterling companies. We can now give these a fresh, shiny name. These are sterling companies. They have a reputation to uphold because they never lose money. Ever. Turns out, not being a sterling company itself is not a wonderful thing, because the market seems to be suspicious that they will lose money maybe. I think it's better to be a sterling company that's not lost money than a sterling company that has lost money. We can test that right now. We were at 50% here in a 10-year period. Now I'm going to run it again, and we're going to see that we're at, oh wow, 25%. So it does make a difference. Sterling companies outperform, but companies that have had multiple bad quarters seem to outperform them still. Perhaps because we're including companies that are development, speculative stage companies. Let's try something a little bit weird. Let us temporarily remove this, and let's test while we're doing this. Let's test to see what happens if we include only companies that have never made money. These companies either have never had an EPS, or if they've had an EPS, it was negative. So we're now searching for nothing but money losers. If a company ever earns any money, it can never be in the screen. Ever. So SiriusXM could probably stay in the screen for quite a while, as could some of the other big companies. Doesn't mean they can't make cash flow, doesn't mean they can't do other things, but they can't return a positive EPS. If they do, we don't want them anymore. This screen should be an amazing short, but I suspect, based on what we've just seen today, that it won't be. And this tells you how weird and unusual a place the stock market is. Same result. Alright, having been inspired, let's find companies that have never sold any product. These companies not only haven't made money, well, they may have made money, but if they did it by not getting any cash in the door. So I leave it as an exercise to the reader how you can make money without getting any cash in the door. I'm sure there's an accounting way using FASB or generally accepted accounting principles to do it, and I would love it if someone who finds out a way to do it would email me, because then I will search for the companies that do that. We have all the data in Morningstar, and it will probably be a wonderful short screen. Perhaps I ought to do a screen looking for companies with positive income. Wow! So, if you're going to be a successful company in the stock market, perhaps you better just not sell any. Let's see who's here. Who are all these companies that aren't selling anything? Really? Wait a minute. Okay. They clearly sold something. I think they're just not courting. Oh, we are an idiot. We have made a simple error. These companies are ADRs. Because they're ADRs, they have no quarterly earnings. So we just bought a bunch of high quality foreign stocks and realized that they didn't do quite as well as the American stocks. This is why you must test all of your theories carefully. Now, let's go find all the companies that have never sold anything. I could have also done a not ADR. That would have actually worked just as well. In this case, I decided to look for the yearly statements, figuring that they're more carefully audited and that they have to file yearly statements. As far as I know, there are no equities traded on U.S. exchanges that don't file yearly returns. After that, what we're going to do is we're going to either get rid of the ADRs and rerun the screen, or we're going to go to EPS 1Y and see what happens. And my guess is that the world will seem a lot more balanced and understandable at that point. Wow, we do have some companies. However, unsurprisingly, most of these are probably either new and therefore haven't had time to make much money, or totally speculative, or both. Backtest this pile of beans, and I really do mean pile of beans, because this is just a Now I've gotten rid of the foreign companies for good, just to make sure, because I'm having trouble believing my eyes. The stock market is fueled on hopes alone. And with that, I'm going to decide that you probably should have sold your company, but in reality I would do more research before selling Viacom.